Welcome back to the Deep Dive. Today we are opening up the hangar doors and diving straight into the latest from Delta Airlines, ticker DAL.
Yep, this was their Q4 2025 earnings call, which just happened on January 13th.
And this one is particularly interesting because you've got this real conflict at the center of it.
You really do. On one hand, Delta reported, very strong Q4. Solid execution, beats on earnings, even record cash flow, but then the market just reacted with immediate caution.
We saw the stock trade down pretty quickly, right?
Oh yeah, it dropped immediately, somewhere between 2.6% and 3.6% in early trading. So our mission today is to really unpack that disconnect. Why did a great quarter lead to such a nervous market?
And what did management tell us about the long-term levers they're pulling, the things they see as being sort of recession-proof?
Exactly.
Okay, so let's start with that backward-looking success, because you really can't deny they delivered.
No, you can't.
In the Q4 snapshot, they reported GAAP earnings per share of $1.86.
Which was a huge beat. The street was looking for something like $1.57. So that's a 29-cent beat right there.
And the adjusted EPS.
That was also a beat, just a smaller one.
Yeah.
They hit $1.55 a share, which was just a little ahead of consensus. So on the bottom line, they absolutely delivered.
But, and this is a pretty big but, the revenue story complicates it a bit.
A little bit, yeah.
They reported a record $15.4 billion, but that actually came in just shy of the street's expectation of $15.75 billion.
And that's a key distinction. It tells you the earnings beat came from discipline, from selling more expensive seats, not just from, explosive top-line growth.
So financial discipline and product mix.
Precisely. They maintained a really strong double-digit operating margin, hit 10% for the quarter, and management was clear that margin strength was all about premium demand and their loyalty economics.
And for the full year.
The full year was just massive. Record revenue of $58.3 billion, and, maybe more importantly, the highest free cash flow the company has ever seen, $4.6 billion. That much cash tells you the underlying business is very, very healthy.
Okay, so let's unpack this. If they beat on earnings and produced record free cash flow, why did the market get so anxious? Why did the stock drop?
Because the market lives in the future, always, and specifically the immediate future. The whole swing factor here was the guidance for Q1 2026.
Which implied a pretty big slowdown.
A huge dip in the pace of profitability, yeah.
So how soft were they projecting?
For Q1, they guided adjusted EPS way down to a range of 70 cents to $1, and revenue. They projected it to be flat to maybe plus 4% year over year.
Wow. Okay, so coming off a strong Q4, that's a sudden brake pump.
It is. Now, management tried to soften it, saying the year is off to a robust start, but that Q1 guidance just screams margin compression. That's what investors grabbed onto.
That definitely clarifies the short-term pressure. But let's go back to long game, because they also reiterated a really bullish full-year 2026 target, didn't they?
They did, and that's the real tension here. They maintained their profit per share framing of greater than $7.75. Then they gave a full-year revenue growth outlook of 6% to 8%.
And the official EPS range?
The official range was given as $6.50 to $7.50. So the market is now trying to figure out, is that soft Q1 guide for real? Or is this just classic sandbagging to set up an easy beat later in the year?
I think that's the friction point. I mean, if you're citing record cash sales in early January, why signal flat revenue growth for Q1? Did they see some kind of demand cliff coming in March that they're not talking about?
It's all about the composition of that demand. We'll get to the main cabin problem in a bit, but the company's really just relying on its core strategic pillar to get it through any turbulence.
And that pillar is the loyalty engine.
The loyalty engine. This thing is the ultimate structural advantage for Delta. It's this giant high-margin buffer against whatever's happening in the general market.
And it all comes down to that American Express partnership.
It absolutely does. This is where the real money is made. They emphasize how durable the SkyMiles program is, and they reported that the Amex remuneration, that's the payment they get from Amex, grew 11% in 2025.
And that number is just staggering.
It is. It reached $8.2 billion.
I just want to pause on that for our listeners.
Yeah.
$8.2 billion. That single annual payment from Amex is more than the total operating income of several other major U.S. airlines combined.
Right. It's basically a high-margin, almost recession-proof financing arm that's just embedded inside the airline. It totally de-risks the model.
And I think management said something like 60% of their revenue now comes from these diverse streams.
A massive 60%. Loyalty, their MRO business, cargo. It means less than half of their income is reliant on the super volatile passenger ticket sales that define everyone else.
And they're not stopping there. They're targeting that Amex number to hit $10 billion.
A $10 billion target within the next few years, which is a huge leap.
What are the risks to that? I mean, they made some changes to the SkyMiles program recently that caused some friction. Could that derail things?
They seem to think the data supports their optimism. They noted that only about a third of active SkyMiles members even have a co-brand card. So they see this huge runway to convert the other two-thirds into these super profitable cardholders. The Amex relationship is their moat, and they're just digging it deeper.
Okay, so let's shift from the loyalty flywheel to the fleet. They also made a huge announcement there, a big long-term bet that seems to clash with that Q1 anxiety.
It does, and that contrast is really the aha moment here. While everyone's worried about Q1, Delta went and placed a firm order for 30 Boeing 787-10s with options for 30 more.
And those deliveries don't even start for years.
Not until 2031. This is Delta placing a multi-billion-dollar bet on their structural economics a decade from now. They're basically telling investors, look, we're sound. Ignore the short-term noise.
So what's so special about the 787-10 for them operationally?
Well, management highlighted that these new planes deliver up to 10 points of margin advantage over the older planes they replace.
10 points. So for every dollar they earn, 10 more cents drop to the bottom line compared to the old planes.
Exactly. Plus, they're 25% more fuel efficient. This whole fleet renewal is about securing superior economics for decades, especially as they expand into Asia and the Middle East.
Now let's pivot to something the street might have missed amidst all this. The leadership shift. There was a big executive transition announced on the call itself.
A really critical point for continuity. Glenn Halmstad, their longtime president who basically built this premium and loyalty machine, announced his retirement.
And that could have been a shock.
Could have been, but they managed it very carefully. They immediately elevated Joe Esposito, who's worked with Hallenstein for decades, into the chief commercial officer role.
So the signal is what? Seamless transition.
Total continuity. Esposito is seen as the co-architect of this whole strategy. By promoting him, Delta is signaling that the game plan is locked in. The path to that $10 billion Amex target is not changing.
Okay, let's get back to the investor context then, and the real reason for that cautious guide. Demand visibility.
Right.
We know corporate and premium are strong, but what about the overall market?
So the signals were actually surprisingly robust right before the call. Management said they had record cash sales in the week just prior. And it wasn't just in one spot. It was broad-based acceleration across the board.
So again, if sales were hitting records in early January, why the conservative guide?
This is it. This is the single most critical insight that came out of the Q&A. Despite the acceleration in premium and corporate, the recovery in the main cabin has not happened yet. Not in price, not in demand. Management explicitly said that to hit the high end of their annual guidance, that 750 EPS number, they need to see the main cabin recover.
So the average person buying a basic economy ticket hasn't shown they're willing to pay higher prices yet. Delta's fighting a price war at the low end while the premium flyers spend freely.
Exactly. And that ties right into what they're seeing in the broader industry. They basically said the low-end commodity carriers are getting crushed. They're not earning their cost of capital.
And Delta thinks that will lead to rationalization.
Which is a corporate word for consolidation or, liquidation. They believe that process will naturally lift prices for everyone, including their main cabin.
And they have a huge advantage in that environment, right? They mention a 115% unit revenue premium.
Their figure is just massive. It means for every available seat they fly 1 mile, Delta earns 115% more revenue than the industry average. They're making more than double what their average competitor makes on the same routes.
Because of premium seats, corporate contracts.
All of it. This structure lets them survive the pressure at the low end, but they still need that overall price floor to rise to really hit their big upside targets.
Let's talk financial discipline. They've got that huge free cash flow number, $4.6 billion.
And discipline is the priority. They're guiding to another $3 to $4 billion in free cash flow for 2026. And their number one priority for that cash, debt reduction.
They ended 2025 with leverage at 2.4 times.
And they are aggressively targeting 2.0 times by the end of 2026.
Which is pretty conservative for an airline. Does that signal they're bracing for a recession or just showing confidence?
It's a bit of both. De-risking the balance sheet is always smart, but hitting that 2.0 target also unlocks their ability to really ramp up shareholder returns down the line. It's a sign of a very mature business.
And one last piece here, a segment that often gets overlooked, but they give some new detail on their maintenance, repair, and overhaul business, or MRO.
Yes, this is a key advantage. While other airlines outsourced their maintenance years ago, Delta kept theirs. It's currently a billion-dollar business for them, with high single-digit margins.
And they want to grow it.
They're targeting 2 to 3 billion in revenue, with margins in the mid-teens. It's another durable, high-margin services business that's way less sensitive to passenger demand cycles.
Okay, that brings us to our final segment, the part of the deep dive where we pitch something fun, maybe a little contrarian, based on what we heard.
And cue the standard disclaimer. This is absolutely not financial advice. We're not investment professionals. This is just a thought exercise.
With that out of the way, what outrageous but plausible trade idea did this call surface for you?
The outrageous but plausible trade here is to go long on the idea that the main cabin recovery isn't just a hope. It's an inevitability driven by industry collapse.
So betting on the failure of Delta's competitors.
Specifically, their low-end competitors. Look, management couldn't have been more clear. They said the commodity carriers are struggling badly. They can't earn their cost of capital. They believe the industry has to rebalance through rationalization.
And that's the plausible part of the trade.
That's the plausible part. The truly plausible part is that Delta's own management said main cabin recovery is the one thing they need to get to the high end of their own EPS guide, that $7.50 number.
So the trade is bet on the failure of the low-end market, which creates the pricing power Delta needs to hit its own upside target.
Precisely. If one or more of their struggling peers had to consolidate or liquidate in 2026, that reduction in cheap seats provides the exact lift Delta's is waiting for. The outrageous part is betting on someone's demise. The plausible part is that management gave you the roadmap to their own best-case scenario.
That is a fascinating insight. Okay, to quickly recap for everyone, Q4 was a story of solid execution, record cash flow, all stabilized by that $8.2 billion loyalty engine.
But all the caution, all the anxiety came from the Q1 guidance, which reflects that waiting game for the mainstream consumer.
Right. And all their structural advantages, the premium mix, that huge revenue premium, the long-term fleet bet, they all remain perfectly clear.
So the one question that should really stick with you, the listener, is this. Is that soft near-term guidance just management being conservative, setting a low bar they can easily clear? Or, given the record bookings they're already seeing, how long can the main cabin really lag behind before something has to give? That's the key question for the next 90 days.
That's the kind of knowledge that turns an earnings report into a real structural insight. Thank you for taking this deep dive with us.